Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Miles Udlin,
Wow,
making
where
his
am I?
long-awaited return
Where am I?
here today.
I have been teleported into 2020.
How's it feel?
It's a little weird, to be honest.
All right, well, we're excited to finally have you back.
100% sure what's going to happen here.
You finally agreed to join us here. All right, let's get everyone up to speed on the market action. We got an hour to go in the trading day. Certainly has been a very eventful week for the markets as we head into the close. The Dow up just about 72 points, on track for its 10th straight day of gains. The S&P back in positive territory today, up about 0.2%. The Nasdaq just below the flat line. And Miles, when we talk about the fact that investors have had a number of earnings reports to digest over the course of the week, the Dow at least able to keep its momentum intact.
Yeah, 10 straight days we're looking at here, longer streak since 2017. I know Jared Blickery is going to join us a little bit later to talk about some of what history says this means for the Dow going forward, but also looking kind of at just the major averages here, Shauna. Like we talked about it earlier today, the broadening out of the rally, perhaps, seeing the Nasdaq retreat just a little bit, and seeing the Dow take a little bit more of a leadership role as we sort of figure out what's going to happen here over the coming weeks. All right, corporate earnings off to a decent start this quarter. Banks garnering a positive reception. Tech high-flying names like Tesla and Netflix viewed a bit more cautiously by investors. This coming ahead of next week's major rush of results. Joining us now to discuss is Ahmed Riesco, Chief Investment Officer at Insignia. Ahmed, thanks so much for stopping by today. Let's just start with earnings and kind of what we've seen so far and really what you've seen so far from the names that have reported. Are there any kind of thematic takeaways that you're starting to build kind of into your thought as we get through the next couple of busy weeks for corporates here?
Look, I would say so far we're quite early, although, like you mentioned, next week is one of the biggest weeks in the earnings season, so that should give us a lot more information. If I had to sort of put a rating, I would say it's been okay. I would say, though, there have been some troubling signs, and some of the troubling signs that we're seeing are not so much for right now, but for down the line, for the second half of the year. And what we're seeing is that in some instances with some companies, you saw it with Ford, with Electrolux, even with Volvo, we're starting to see that disinflationary pressures, which are being welcomed on the macro level, are actually going to probably start being a headwind for earnings going into the second half of the year. So that's actually what we're focused on right now.
I mean, how big of a headwind? What are we talking for in terms of what we could expect here over the coming quarters?
Look, we expect inflation to continue to trend down. It's in a clear disinflationary trend if you look at across various matrices. And like I said, that's good for the macro environment, that's good for the Fed, and that's good for the U.S. economy. But for companies, we think that's going to definitely be a headwind in the second half of the year. Now, we don't think it's going to be a strong headwind to the point where you're going to see the market really sort of take a nosedive here into the second half of the year. But we do expect weakness. So we think the market, the S&P 500 specifically, will end the year slightly lower than where it is today.
And, Ahmed, thinking about kind of the market over the balance of the year, I was just looking at the note you sent over, and kind of high up, you highlight that that consensus view headed into 2023 is that stocks were going to fall. And we have seen Wall Street kind of, try to, let's say, back into a more acceptable outlook for the market. But I guess just in thinking about, the pack dynamics maybe for strategists, what's been your takeaway from, the market once again, kind of the old cliche, inflicting the most pain on the most possible people with kind of what we've seen this year?
Yeah, I think what you're seeing now is strategists are also sort of trying to catch their tail just when you see them starting to turn more bullish is when we think we should actually perhaps start taking some risk off the table. Although we think it's perhaps a little bit too early to take risk off the table. Technically, this rally looks very sound, and it looks like it could extend for quite some time. But going into the second half of the year, like I mentioned, we do expect weakness. Now, remember, this was the first year in the history of the Bloomberg data series that Wall Street, as a consensus, expected the S&P to go down. And obviously that has not happened, and we don't expect the S&P to end the year on a negative trend. But like you mentioned, this sort of highlights the perils of when you get into groupthink. And when everyone starts sort of singing the same tune, that's a very good opportunity to go contrarian.
Now, we spent a lot of time today talking about the equity market, but I want to ask a little bit about private markets, what you're seeing there. And I guess as you think about building the portfolio, what looks more interesting to you today than equities? And because that's a large world out there of alts, whatever you want to call it. What are the things in that space that are most interesting to you guys today?
Yeah, so first let me start by saying that we definitely think that for sophisticated investors who don't have the liquidity needs, private investments are going to be a crucial part of their portfolios going forward, precisely because we don't expect public market returns to be as good as they have been over the last 10, 20 years. That being said, they're not a panacea either. They obviously have risks. The mark-to-market doesn't happen as often, so many times investors are sort of saved from themselves from making emotional decisions. But there could be extremes, and what we're seeing right now is that private credit looks a lot more attractive to us than private equity. Both spaces have seen a lot of money go in. There's actually a concerted effort in the private investment world to expand the investor base, to go beyond pensions and institutions and start including more retail clients. So that's going to definitely, pressure returns in the space generally. But drilling down, private equity looks a lot less attractive to us. The macro environment is less attractive for it, and the valuations are still quite high. So we would suggest that investors who are going into the private investment space right now to allocate more money to private equity than they otherwise would.
Ahmed,
To private credit.
Ahmed, how does the Fed's upcoming meeting here, just in terms of your expectations for a recession, the fact that it doesn't sound like, at least from your perspective, that we're out of the woods quite yet, given that portfolio allocation that you think is attractive at this point, how do you think the Fed's narrative maybe potentially reshapes the market's momentum here going forward?
I don't think the Fed's going to surprise the markets. At this point, if you look at Fed funds futures, they're basically pricing in over 90% chance that the Fed raises rates by 25 basis points next week. I think they're going to do that. I think if they did not want to do that, they would have a signal to the market beforehand, and that has not happened. So we fully expect that rate cut, even though we don't think they should, by the way. But that's another story. The signaling is going to be important as far as, because what the market wants to hear, given the rally that it's had, is that the Fed is done pretty much, and that this is the last rate hike of this cycle, and they need to sort of telegraph that in any way. If they don't, or if they signal something to the contrary, that perhaps the other meeting will also be a live meeting, so to speak, you could definitely see some pullback here, given the strength of the recent rally.
Well, so let's double click then, Ahmed, on that notion that the Fed, in your view, should be done here. Is that just based on what we've seen in those headline inflation numbers coming down, or is it more about, the financial stability risks perhaps that were surfaced, back in the bank crisis in the spring?
It's a combination of both. Look, the Fed constantly makes policy mistakes. It's actually irrational belief to think that they're committing one now. Historically, they do. So if you bet that way, you're going to be more often right than you're wrong. So the Fed clearly waited too long to begin this hiking cycle. What that's likely going to mean is that they're going to probably overextend themselves and perhaps overtime here. I think if they would have probably paused one or two meetings ago, the chance that we could actually have a soft landing would be materially higher. Part of the reason why we are, although we're in the short term not projecting a U.S. recession, part of the reason why we think a U.S. recession will begin sometime in the middle of next year is precisely because of how tight monetary policy has gotten.
Yeah, certainly, Ahmed. We are both old enough to remember when 2.5% was seen as the terminal rate, and here we are approaching 5.5 on the upper bound. Ahmed Riesco, Chief Investment Officer at Insignia. Thanks so much for your time. Have a great weekend.
Thank you. You too.
A strong start to second quarter earnings season and solid economic data. Well, that has a number of economists pushing back their warnings of a looming recession. Josh Schaefer is here with a closer look. And Josh, this recession prediction that we've heard so many economists warn us about now for quite some time hasn't exactly come to fruition yet.
No, Sean, it keeps getting pushed back, right? We were talking about the 2023 recession. Now we're talking about the 2024 recession, or are we even going to get a recession, right? And so Goldman pushed back their likelihood of a recession earlier this week. They had been at 25%. They had been up above 30% earlier this year. They're now saying in the next 12 months, there is a 20% chance that we will see a recession this year. And I was on with a media roundtable earlier this week with their chief economist, Jan Hatzius, and I thought one phrase he kept coming back to was interesting. He kept calling it unspectacular growth, meaning we're not going to see anything that's going to be eye-popping. We're not talking about crazy economic expansion necessarily right now, but unspectacular growth, and that's just fine when we think about in terms of a recession, right? Retail sales this week, up 0.2%. Growth, right? It's just growth.
I was going to ask you about that because it's like, we write the story, okay, retail sales up 0.2%, it misses expectations, and of course, predictably, all the notes come in, here it is, this is softness. But annualize the last 3 months of sales, we're still seeing sales higher, and we're still seeing this number in particular, I guess we're going to do a retail sales segment here, but impacted by a negative read at gas stations. So it is actually a little bit stronger than that headline suggests. And if a little bit stronger than the headline isn't the story for the U.S. economy right now, then I don't know what a better one would be.
And a lot of people are pointing to that control group number too, right? Because that's what actually is put into the GDP number that we end up coming out with, and the control group is up 0.6%. So when you look at it that way, you're seeing some consumption happening, and that's something that a lot of economists just end up coming back to in terms of this consumer story we're talking about. That's what everyone is stuck up on right now as well. If the consumer's resilient, then that's probably just fine. Right now, you're looking at real disposable income, so how we are sort of able to pay for things, right? And if income's still rising, and it wasn't last year, that's a pretty good indicator.
Well, and I think because nominal income has been flattish, let's say roughly, but now inflation is coming down, so now real inflation-adjusted income is all of a sudden starting to look a lot better. And I think it gets to the conversation we were just having with our prior guest about, well, the Fed doesn't really feel like it needs to do a lot different because all of a sudden people are like, they're not making more, but quote unquote, they're making more because you are having fewer inflationary pressures on whatever your take home is.
And you have inflation coming down pretty significantly too, right? There's a lot of talk about inflation being up, but the economists that are in this camp of saying, we're probably not going to get a recession, they're saying, well, you had inflation at 9% last year headline, now you're at 3%. Yeah. At some point, how fast can it come down? It's coming down, just wait.
All right, well, we'll wait to see what we hear from Powell next week. But I think still, what are the odds of a hike? Is it still 98%?
It's well over 90%.
Above 90%.
I saw 99.8, I think.
99.8%. All right, well, we'll see. Maybe
no drama.
Something that he says in the conference will catch markets off guard. All right, Josh, thanks. Well, we are just getting started here on Yahoo Finance Live. Coming up, Amazon, Google, Meta, Microsoft, and other big tech companies have agreed to a set of AI safeguards. And executives are meeting with President Biden at the White House. We're going to break down what it all means for tech giants. Plus, earnings season putting the pedal to the metal next week. GM and Ford set to report, and it comes after Tesla's miss on margins. We look at the implications of the price cuts later this hour. And the most anticipated box office weekend of the year is here. Barbie taking on Oppenheimer. But who will emerge on the top of the charts, and is it going to live up to the hype? We've got all that for you when Yahoo Finance returns. Warner Brothers' Barbie has fans buzzing, but it's much more than just a movie to Mattel. The company is betting big on Hollywood, with several movies based on its toys already announced. Here are some of the top films in the works. Polly Pocket. Lena Dunham is planning to write and direct, while Lily Collins is set to star as the famous Micro Doll. Hot Wheels. J.J. Abrams' company Bad Robot will reportedly produce the film based on Mattel's toy car brand. Thomas the Tank Engine. Set to be directed by Quantum of Solace director Mark Forster, the movie will be a mix of live action and animation. Rock'em Sock'em Robots. Vin Diesel is set to star in a live-action movie based on Mattel's two-player action toy. And Viewmaster. MGM and Mattel are reportedly teaming up to produce a live-action movie about the stereoscope toy. If Barbie or any of the Mattel films want to be the queen of the box office, they'll have to take down Hasbro's Transformers, the highest-grossing movie series based on a toy franchise. Let's do a check of the market sponsored by Tasty Trade. Dow holding on to gains up for the 10th trading day in a row, up 36 points. S&P in positive territory. The Nasdaq just below the flat line. In terms of the sector action that we're seeing today, utilities, healthcare, and energy among the leaders. Communication services and industrials, the worst performers today. Also taking a look at the VIX as we get ready to close out the trading week. We're looking at the VIX here, off just a bit, 1363.
The Dow has to be positive. That's the whole story today. 10 straight days up for the
be.
Dow. I hope you hang
bring
inside.
the luck.
All right. An eventful year for investors. Tech stocks are ripping. The AI hype machine is in full force, and energy is giving up its leadership position from a year ago. So as we approach the end of July, let's dive into some stocks with our next guest and see what he likes. Will Ryan, founder and CEO of Granite Shares, joins us now. So Will, let's start with AI. I think we may know the play there, but I guess, not only what names you like, but how you guys have thought about that theme and how quickly it really came on for investors.
Yeah, no, absolutely. I mean, by far and away the trade of the year in terms of AI. I think the difference being that people really, believe that this is something that is real this time, as opposed to a short-term fad. So NVIDIA has been front and center of every investor's mind. The stock performance has been unbelievable year to date. And we've been able to sort of participate in that, if you will, with our NVIDIA ETF. So we have a leveraged single stock play on NVIDIA for people to get exposure. And that's been a good way to play it.
So how much, I guess, two parts. How much inflows have you seen, or what's the inflows been like to that product specifically? But then also, how do you guys think about where that fits into a portfolio, and like how someone might want to use that name if they see that option on the menu? Yeah,
so we were, I guess, nearly 200 million in terms of inflows year to date in NVDL, which is the NVIDIA stock. And I think there's a number of different ways that people use it. I mean, clearly one of the problems with AI is it's this kind of amorphous concept where a lot of people say, hey, I want to play AI, but how do I do it? And so when they go to the broad diversified ETF market, they might find ETFs, even ETFs that labeled AI. The challenge is inside it, you get a bunch of stocks that really sometimes can have very little to do with it. So that's where something like a very concentrated exposure like NVIDIA itself, or the leveraged single stock version, has been so popular.
Well, how are you looking at the valuation aspect of NVIDIA? The other stock that you like within this space that has been largely tied to the AI rally is Meta. There's been some concern out there just about the lofty valuations that we are seeing from companies like that. Why is that not giving you pause?
I think that, as I sort of said at the beginning, I think that the difference for me is that I think AI is real. It's not just a short-term hype where people got in and in 6 months' time we'll have forgotten all about it.
Do you think we will, though, see a bit of a pullback here, at least in the short term?
It's possible. I think that if you look at every analyst on the street, they're kind of overwhelmingly bullish on NVIDIA, with some people pricing NVIDIA $100+ higher than where the stock trades today. There's no doubt that there's been multiple expansion from a lot of these big companies from where we were last year in the first half of this year, and that will have to be backed up by fundamentals in the next 6 months as we get towards the end of the year. But I think a company like that is just so well positioned, and in a market where everyone's out there digging for gold, a company like NVIDIA is providing the shovels.
I guess when you raise your guidance by 50%, you get away with some things when it comes to valuation. Let's talk about a couple of names you're a little more cautious on, and one that stands out to me is Home Depot, particularly since we see demand for new homes or home builders are very excited about their prospects. But when it comes to existing homes, maybe DIY, what kind of, in your view, is some of the caution around that story?
I think it's kind of what you just said, Miles, is that we've got a real issue with the housing market at the moment, and the housing market is just largely just ground to a halt. Not sale of new homes, because new homes are new supply coming onto the market. Home builders that have supply are selling homes, but for people that locked in mortgage rates that were a lot lower than where the market is trading today, those people aren't moving. And so the kind of the big reshuffle and the fever that we saw in Home Depot and other stocks during the pandemic has definitely come down. And I think that the trouble is that right now we've got to see the housing market start to loosen up, and I just don't see that happening anytime soon, at least until we reverse course on rates.
Well, the other pick that you're advising investors to stay away from is Exxon. Oil still below $80 a barrel. You don't see. We've heard from a couple of strategists that they do think energy is a great buy right now heading into the second half of the year, that we will see that global demand picture improve a bit. Why are you taking the other side of that bet? Because
I think people have to remember that before the last couple of years, in other words, the bottom of the pandemic, Exxon and a number of big oil companies didn't go anywhere for 10 years. The reason for that was that oil effectively, or oil companies, there was increasing pressure from environmental concerns and others about the future of these companies and obviously carbonization more broadly. The stock price has done incredibly well on the back of what we saw in the pandemic, brought forward a huge amount of growth. But the question really is, just like the tech stocks before the pandemic, the question is what came up or what went up massively over the last couple of years. I think now has got room to come down.
Yeah, and it seems like in an environment where you can write a 10-year secular thesis for a stock again, which you couldn't do for a little while. Oil doesn't exactly get people super fired up about the long-term.
It's not a growth
prospects.
story
Yeah.
at the end of the day, and it doesn't have to be to make it attractive. I think Exxon will go back to what it was, which is a company that has fantastic cash flows and can pay a good dividend. Mm-hmm. But it's not going to be a stock that doubles or triples like it did over the last few years.
And Will, quickly before we let you go, I want to ask about gold generally, and just kind of thinking about portfolio positioning right now. And I think a lot of people who maybe weren't even super overweight tech, now because of the rally, all of a sudden have a ton of tech in their portfolio, might be thinking, I would like to get rid of some of this and buy something else. How are you thinking about gold at this point?
Well, I think gold is in a good position at the moment, and the key word is the dollar. That we're kind of at the metaphorical top of the mountain, if you will, with interest rates as opposed to the bottom or halfway up. And so gold prices hanging in here quite nicely because we've seen the dollar weaken from the peak last year. And so just like with a lot of these top tech companies, a tailwind that's going to come into the market is those that have big international earnings that got hampered last year because of the dollar strength will now see that as a tailwind with a weaker dollar. And it's the same for me with the gold market.
Great. Will Ryan, founder, CEO at Granite Shares, thanks so much for stopping by. Have a great weekend.
Thank you.
Well, the Dow fighting to hold on to 10 straight days of gains here. Jared Blickery is here with a closer look at some of the movement that we've seen over the past couple of days. Jared.
Yes, Dow is up 10 straight days. This is the look that we've had over the last 5 days. So this week's price action producing a more than green board here. But let me show you. I looked back through history. I found 15 other instances where the Dow gained 10 straight days going back to 1920. So that's over a century. And these are kind of few and far between. We've only had 1, 2, 3, 4 prior instances this side of the year 2000. When you take a look at the 1 week later gains and losses, really only 60% up. I'd say if you're having a gain of 10 straight days, that's probably going to be overbought. So not surprisingly, a lot of those rolled over. Now you take a look at 1 quarter layer, things move up. You got 80% wins with an average gain of 2.5%. That's respectable. 1 year later, we go back down to about 2/3% gains, and the average gain is 1.32% versus a median gain of about 4.5%. Big disparity there, and that's because a couple of these lines, they bring down the average. July 3rd, 1929, right at the top of the 1920s, the roaring 1920s bubble, right before the Great Depression. 1 year later, 35% down. That's bringing down that average there. So I don't read too much into this, but I think the bottom line is strength tends to beget more strength, and that's probably what we're going to see, short-term implications notwithstanding. Now, I was covering the Dow here. Let me show you what's going on inside the Nasdaq. This is the Nasdaq over the last 5 days. Something totally separate happening at the close today, and that is that special rebalance of the Nasdaq where these guys right here, the mega caps, these magnificent seven, they are going to get their weight downgraded, and you can see the effects of this already front run over the last 5 days. Only Apple is up. You can see Tesla down 7%. Sure, that's an earnings story, but Meta also down 5%, Amazon down 3.7%. So it looks like this has already been priced in here, par for the course. Some of these other issues on the right-hand side are getting a little bit of a bump up. Broadcom and Starbucks included in that mix. And then finally, we have one more thing going on today, and that is options expiration. So busy, busy day. According to Goldman Sachs, there we go. It looks like we got $2.3 trillion of listed options expiring today. About half of that was at the open. Most of those are just index options. But then we have some PM index options. We got single stock options, ETF options. Those are expiring after the close today. So lots going on, a lot of liquidity for a quiet summer Friday, and some interesting things going on with the Dow there.
Jared, it feels like every time there's a big options expiration, the market's flat.
You know what, Miles? Here's the thing.
We've been doing this for like 8 years. It's triple witching, and then the market does nothing.
I can back that up with data. The indexes.
Of course you can.
No, it's right.
So this is somewhat of people say, oh, options expiration, there's going to be huge volatility. Not in the indices, and that's because they average out. A lot of issues get pinned at their strike price. Now, some securities, some stocks, they do experience wild fluctuations here, and we have to account for that. But for the most part, options expiration date is a quiet day. Lots of liquidity, but that does not translate into movement. So hope that solves that.
Just eyeballing the indexes here. Looks like the 4,500, 14,000s they're gonna be in the money, but we'll have to keep an eye on
Miles,
that.
it's great to see you coming out of retirement here.
That's right. Thank you.
I know. It took long enough.
Thanks, everybody. Really appreciate it. I'm going to get to the right
make this a
camera
Friday
here.
thing.
All right, coming up, it's the box office's main event of the summer. Barbieheimer is here. Our next guest has seen them both. Stay tuned for the highly anticipated review and an overview of the state of the movie industry.
Hi, Barbie!
Hi, Ken.
I thought I might stay over tonight.
Why?
Because we're girlfriend-boyfriend.
To do what?
I'm actually not sure.
Mattel is betting big on the Barbie movie. The live-action film, starring Margot Robbie as Barbie and Ryan Gosling as Ken, reportedly has a $100 million budget. It's a toy maker's big chance to shake up its brand and prove that Barbie is still relevant. Barbie sales accounted for $1.5 billion of Mattel's $5 billion plus worldwide sales last year. It's a big number, but it's still down 11% from the prior year. Mattel unveiled the first Barbie dolls in 1959, and the company went public just a year later. The 1960s was transformative for Barbie. The Ken doll was introduced in 1961. The first Barbie dream house popped up a year later. The doll's popularity took off, with sales passing $1 billion in the early 90s. But within a decade, the doll began to fall out of favor amid criticism for lacking diversity and promoting an unrealistic body image. As Barbie sales struggled, so did its IP owner, Mattel. The company lost its spot as the world's largest toy company by market cap to Hasbro in 2015. Attempting to address some of the criticism, Mattel released a more body-inclusive doll line in 2016. 2 years later, Ynon Kreiz was named Mattel's chief executive, and he brought a new vision to the brand. Dig into Mattel's vast IP and pull out the toys that could translate into hit movies. In addition to Barbie, Mattel is planning 14 more films based on toys.
It will be a way for us to show what does it mean when we say that Mattel is an IP-driven, high-performing toy company, and an opportunity to extend our business outside of everything we do on the toy side of the company.
Between Mattel's business and the lackluster return to the movies, there's a lot riding on the film. So will people show up? We did a little research of our own.
Of course, I have plans to see the Barbie movie. I'm so excited. Yeah. Oh, yes. Yeah, absolutely.
I want to see it.
Yeah, unofficial plans.
Yeah.
I'm definitely going to see it.
Yeah, definitely.
Yeah, I would love to see it.
I want to see it.
I've been waiting for this for years.
We've had an astronaut Barbie, CEO Barbie, and presidential candidate Barbie. But will we get a blockbuster Barbie? We will see whether this hype translates into a Barbie boom. The Barbie movie is officially in theaters, and it's already blowing away the competition. Barbie raking in over $22 million at the domestic box office on Thursday previews, beating Oppenheimer handedly by more than $10 million. Our next guest has seen both of these movies. Joining us now, I want to bring in Gitesh Pandya. He's editor of BoxOfficeGuru.com. Gitesh, great to have you here. So let's start with Barbie, since that has been a lot of our focus here. That's expected to be the outperformer this weekend. There's been so much hype ahead of this weekend for the box office. Does Barbie live up to it?
Well, I think it depends on what you're looking for. I think the target audience absolutely gets what they're looking for. This is a pop culture moment. You also have the whole Barbenheimer aspect of it, which is separate. But this is the bigger of the two movies. It was always going to do better. $22.3 million from Thursday night pre-shows. That includes some of the Wednesday Barbie blowout shows. So I'm tracking this one to do well over $100 million this weekend, probably over $125 million for this opening weekend, which will be the second biggest opening of the whole year. In fact, the Thursday pre-shows were the biggest of any movie this year to date. So the sales are huge. The word of mouth is very strong. It's at around 90% on Rotten Tomatoes audience score, so the people are liking it. And because of this whole double feature phenomenon, there's a lot of people who haven't seen it yet. They're planning to go Friday, Saturday, Sunday. So there's a lot of business up ahead. I do wonder a little bit about the long-term picture here. You might have a lot of people go up front and then less business later on.
So let's talk then about Oppenheimer. We just had the graphic up, expectations for a slower opening weekend for that film. Do you think that that one might have a longer tail? Or I guess as you think about these two movies that seem to be capturing popular attention in a way that we haven't seen too many films do over the last few years. What is it maybe that you think Oppenheimer is channeling in a different way with that kind of energy?
Well, it's certainly a very Oscar type of a film. And I've been tracking the box office for over 30 years. I've never seen anything like this, Barbenheimer. Two very different movies being put together in the conversation. People are talking about both at the same time. Oppenheimer was always expected to be the smaller of the two films. Nothing new there. It's not a brand or an IP or anything. But this is a film where the director is the brand, and you're going to see a longer tail on this one because the word of mouth will be a little bit better moving forward.
So I guess in thinking then about, we haven't seen anything like this before, I'm curious what you make of the way movies are marketed, but the way maybe they catch steam on TikTok, right? Remember the was the Gentle Minions thing? Was that last year, 2 years ago? All of a sudden you got teenagers dressing in suits, going to see a Minions movie. No one's quite sure why, but as you know, CMOs everywhere were saying, how do we make this happen? So in your view, how are theaters or studios succeeding, failing, flailing in trying to get that kind of organic? It's not organic, but seemingly organic.
Yeah, it's semi-organic. It's critical. It's absolutely critical to the overall picture because this is how people communicate. This is how people talk about things, how something gets hot. And Barbenheimer came up through the people. Two different studios never join forces to market their two movies together when they open on the same day. That never happens. So this is the people coming up and saying, listen, I'm interested in both movies. I'm going to make fan art, spread it around social media, and then sort of the whole chatter kind of came from there. And now what it's good for is for the business because it's expanding the marketplace. Two films opening this big, probably over $200 million in combined sales this weekend. You almost never see that. So the marketplace expands. It's a global phenomenon because the overseas sales are very good on Barbie as well, and also for Oppenheimer. So you've got more people going to the movies, and that's something that the studios really need right now.
When it comes to Barbie, this is obviously a nostalgia play when they're really marketing to people who used to play with Barbies 20, 30 years ago. Mattel has a whole slew of films that they are lined up here for some of their past hit toys. Hot Wheels, Thomas the Tank Engine, just to name a few of them. Are we going to see this type of success and this type of hype, do you think, for those installments, or is this hype very Barbie specific?
Well, it's very Barbie specific. I think that there's no guarantees for the future projects. You have to make a good film. Greta Gerwig has done some terrific films before. They hired her to make Barbie, and she did a bang-up job here. This is like great with the critics, great with the audiences. People are loving it. I'm sure Warner Brothers will pull up with a dump truck full of money to make her do part 2 sometime after the strikes are all over. So it depends on how well you make it. I think some of those Mattel movies might flop if they're not made well. But if you look at different IP, people are turning everything into a movie. Video games, toys, there was G.I. Joe, there was Transformers, there's Barbie. So if you make it well, people will come.
And maybe it's just me floating into your area of expertise, but I think I just wonder when, if ever, we reach sequel saturation. And perhaps it's just a misread that this is the way it's always been.
Right.
And so we're just kind of making up something that doesn't exist. But in your view, as someone who follows this week in and week out, has there actually been a market uptick in sequels? And does it feel like audiences want something new rather than the 19th or 20th Marvel, however many of those movies there have been?
Well, I think sequel fatigue is something about talk and not action. We talk about sequel fatigue. There's too many. Why do they keep making them? But if you look at the action, if you look at what people are buying tickets for, every single year without fail, the sequels are the ones who are maybe 7 of the top 10, 8 of the top 10 every single year. So people keep coming out for the sequels, but there's room for original, if you call it original, or some new IP becoming a first of its kind movie. Super Mario Brothers, which is not a sequel, is the highest grossing movie of this year. Barbie is about to have one of the biggest openings of this year. So there are movies which are not sequels, but based on IP. They have a built-in audience, which are becoming blockbusters. And I see more of that coming in, but you do have to have some room for the Oppenheimers of the world, where you have directors that people really trust, and they'll go see anything he or she makes. And that's what you have this weekend with two different movies at the same time.
Kutesha, has been, though, some chatter online, people very upset with the strikes that are happening, the treatment of actors, of writers here by the studios. And there's been some talk that maybe people are going to boycott the movie theaters over the coming weekends. How big of a concern is that within the industry?
Not much of a concern. I think as far as the movie theaters go, it's really product driven. People love Barbie, they love Oppenheimer, Mission Impossible is still out there doing well. There's some new movies coming out in August and September and so on, horror films coming up this fall. So people will still go out for those films. The difference you'll see is that the actors on strike will not be promoting their films. And so that makes a big difference. And some studios will have to make the call. Our stars will not be promoting this film. Do we still release it as is, or do we push it to later when we hope the strike is over if they need them to be on social media and promoting their films? Or is it a big brand that sells itself and then you can just kind of put it out there in the marketplace anyway? But I don't see consumers boycotting movie theaters all that much right now.
So switching gears a little bit, I want to talk about the theater experience. There was news out that AMC is dropping plans to charge customers different prices based on where they sit in the theater. Essentially, people would pay more for a good seat. They weren't sitting in the front row for a discount.
Right.
And it just made me think about, the theater experience generally, how it has changed. You have the Alamo Draft Houses of the world and such. And what, in your view, is changing, needs to change, should change, isn't changing fast enough, perhaps, when it comes to getting people who are on the margins of wanting to see a movie? I see a movie, maybe once a year, twice a year? Like, what needs to happen for me to go 3 times?
Well, first of all, go more often. Second of all,
I'm going tomorrow. Listen, I'm doing what I can.
Is Barbie your one movie of the year?
Last year we saw
back.
Mission Impossible last year, which was, we saw Top Gun last year, which was amazing, and now we'll see Barbie.
Right. Well, the different prices inside the same auditorium, that's something which other countries have used with mixed success. So you have AMC and some others trying to replicate that over here. I don't think it's that great of an idea. I think consumers over here are not really interested in paying a premium to sit sort of in the center where you kind of get the best picture and all of that. So that's an experiment which I don't think worked out too well, and you'll see that go away. I think what does make sense is discounting. And so when you have discounting, more people say, you know what? 2 for 1, I can go and see this movie. It's not going to destroy my wallet. And so maybe I'll wait until Tuesday or whatever day it might be. And that can get more bodies in. And the more bodies you get in, they see posters, they see trailers, and they might come back for more.
All right, we'll see how big of a hit this weekend is. You already got one person on board. I don't really have plans to see Barbie yet. I'm not sold.
Well, you got to get a sitter. I mean, we lined up the sitter like a week and a half ago. You got
to prepare, and you got to get the tickets early. All right, Gitesh, always great to have you. Thanks so much.
Great, thank you.
All right, coming up, the latest in the wage wars between UPS and Teamsters as the strike deadline nears. We've got the latest for you. Stay tuned. Warner Brothers' Barbie has fans buzzing, but it's much more than just a movie to Mattel. The company is betting big on Hollywood, with several movies based on its toys already announced. Here are some of the top films in the works. Polly Pocket. Lena Dunham is planning to write and direct, while Lily Collins is set to star as the famous Micro Doll. Hot Wheels. J.J. Abrams' company Bad Robot will reportedly produce the film based on Mattel's toy car brand. Thomas the Tank Engine. Set to be directed by Quantum of Solace director Mark Forster, the movie will be a mix of live action and animation. Rock'em Sock'em Robots. Vin Diesel is set to star in a live action movie based on Mattel's two-player action toy. And Viewmaster. MGM and Mattel are reportedly teaming up to produce a live action movie about the stereoscope toy. If Barbie or any of the Mattel films want to be the queen of the box office, they'll have to take down Hasbro's Transformers, the highest grossing movie series based on a toy franchise. Tesla shares in the red for the week. We're looking at a loss of just over 7%. The stock taking a hit after recent price cuts pressured margins in its most recent quarter, and that overshadowed beats that Tesla posted on both the top and bottom lines. Here with more on what this means for the EV giant and also what we could expect here from other automakers over the next several weeks. I want to bring in Tom Narayan. He's RBC Capital Markets equity analyst. Tom, it's great to see you here. So despite some of the concerns that we're seeing from the street, you reiterated your outperform rating. You kept your price target of 305. Why aren't you buying into some of the worry that we have seen from others, from some of your peers?
Well, I think Tesla is kind of a little different than some of the peers, right? So I think, for Tesla, it's really about the future, like way into the future. Their numbers came in great. It's just that they did say that they're going to be cutting some production in the third quarter. A lot of folks wanted them to blow out of the park and raise the guidance on Model 3 and Model Y production for the year. That's probably not happening. So I think some kind of short-sighted people probably took some money off the table there. But really, it's about what Elon said on the call, licensing FSD. That's going to be a game changer. That's the biggest driver, really, for my 305 price target.
Tom, I'm curious over the course of the last, let's say, 3 or 4 months, what the most common question that you've gotten from clients is on Tesla specifically. Obviously, the stock we know through history has done all kinds of crazy things, up, down, sideways for all kinds of periods of time. But this year, it feels like when you've seen with the free cash flow, you've seen the delivery numbers, the story feels a little bit different maybe than it did in prior runs. I'm just curious what the reaction has been, what those conversations have been like with your clients.
Yeah, the main questions really have to do with the price cutting. Does that mean that there's a demand problem, right? And I think cutting production in Q3, now this is planned cutting just to upgrade the production plants. That's all it is. But I think that does add fuel to the fire where people may think, oh my God, there's a demand problem for Model 3, Model Y. So a lot of folks are wondering, what is the next car in the pipeline? We know it's been speculated, and Elon has talked about this Model 2 car, which is going to be this lower-priced car, high-volume car we're going to start seeing in 2025. So that's really where everyone wants to see what's the next big car to come out for Tesla, and has demand waned a little for 3 and Y. We think that's not what's happening, but we are excited about this new car that could be coming in 2025.
And I'm curious what you guys think then of the truck. I enjoyed Elon's color on the call with, what was it, so far off the hook, there's no hook for demand there. Just curious how you think about that forthcoming product.
Yeah, it looks like some pretty strong demand here. If what's indicated in the press on the price point could indicate some trouble for some of the Detroit 3 with their electric trucks, as far as how they're priced, because it looks like Cybertruck is going to be priced potentially in the $40,000 to $50,000 range, and it offers 500 miles of range. And this is all speculated, but if that is the case, this could be a real problem for some of the competitors. I don't know if this is going to be a huge volume maker. I think it's a great market entry for Tesla, and it really showcases the technology that they have. But ultimately, the future of Tesla really rides on the Model 3, Model Y, and then this new Model 2, and what it does, again, with autonomy, FSD, licensing it to other OEMs. That's really where I think investors should focus.
And Tom, one of its competitors, Ford, obviously maybe already starting to feel some of that pressure, lowering the price of its Lightning earlier this week. When it comes to Ford, we'll hear from them next week. Anything that we heard from Tesla signal maybe some of the troubles that we could also see from Ford, or are they uniquely positioned given the fact that they're obviously not as reliant on EVs?
Yeah, I think it's kind of a different story. I mean, certainly actually Ford has actually set themselves up pretty well for the quarter with very low expectations. So I actually think they could do very well. The problem is everybody already knows this. So I think for them, they'll probably, I think, beat on the quarter and raise guidance. But I think that's largely expected. People are really looking when it comes to all these legacy automakers on pricing. So even though they may do great this quarter or maybe this year, everyone's looking at 2024. And pricing seems to finally be falling. We're seeing all this price cutting happening. And now I think that's where the focus is. So even though they may do fine on this, next week or when they report results, I think people are going to be looking past that to 2024 and worried about pricing coming down and the impacts that'll have.
And then, Tom, finally, I just want to ask you about GM, another legacy automaker. Looking at the stock right now, it's at $38. It feels like it's been at $38 my entire life, essentially, save that one run we saw back in the pandemic. Curious what you make of this story, because this is a name, back in the spring you were a bit more constructive on.
Yeah, it's tough because I think that there's some great things going on here as well. You have an EV lineup, which should really boost pricing and absorb some of the pricing we're worried about for some of the other legacy companies. Now you have all these new EVs coming out that are higher priced, the Lyriq, the Mystique, the Blazer EV, the Hummer. So all of this should help, and it's really exciting. The problem, though, is all of these automakers are about to face the buzzsaw of pricing coming down. It's inevitable. Incentives are going up. Used car price data, I'm sure you saw, came down a lot sharply. We're in a disinflationary environment. Volumes are coming back. So in this environment, it's a little tough to be really banging the table, but we do like some aspects of like the EVs coming out. Also, the fact that they do have AI, right? You do have the Cruise, the autonomous robotaxi, maybe the interest in AI all of a sudden that we've seen lately. Maybe that'll create a halo effect for GM. We'll only see.
Yep. Levers management can certainly pull. All right, Tom Narayan, RBC Capital Markets analyst. Have a great weekend. Thanks for joining us.
You got it.
Well, the clock is ticking. UPS and the Teamsters are heading back to the negotiating table next week, just days before their contract expires. Yahoo Finance's Alexis Keenan has been following this story for us. Alexis, what can we expect? Because it still seems like the two sides are very far apart.
Maybe, maybe not. The two sides may be talking a little bit differently about where things stand, but this labor contract expires on August 1st, so the parties say they're going to get back to the negotiation table next week. We don't know exactly what day, but it looks like they're going to have about 7 or 8 days to get this thing to yes. These are 340,000 Teamsters union represented workers at UPS, so a huge employment group there, and talks broke down early in July. So the Teamsters have threatened a strike, and hopefully these talks will get back on the table. Now, UPS, for its part, says there's still time to get this done. They say they've nearly met all of the demands that the Teamsters workers are looking for. So let's take a look at them here. What's not settled is one of the Teamsters' focus, which is on about 100,000 part-time workers. These are workers who work in the warehouse. They load and sort packages. They want their pay increased. Their current pay is about $20 an hour, plus they get benefits. Also, full-time workers for UPS, we don't know what they want. That's still a big question here. We don't know where they stand, but it would be typical for pay to be increased with a new 5-year contract. Also, what is already settled, according to UPS, are a variety of other things. One is to convert hybrid workers. These are full-time workers who work on Tuesday through Saturday, to convert them to regular full-time workers. They don't want that status anymore. They see themselves as second-class workers. Their pay is $36.54 an hour plus benefits. Also, UPS says it's agreed to stop forcing overtime for unscheduled days for full-time workers, also adding more full-time jobs, putting air conditioning in the cabs of its delivery vans for new trucks, also disabling some inward-looking cameras inside the trucks. They're going to do that, and also adding a paid holiday and adding some seasonal hours for part-time workers.
And Alexis, quickly, I'm just curious about the economic impact, first of what if UPS drivers all go on strike at the end of next week, but also just more broadly, how the two sides are thinking about these conversations in the broader environment where you still have an unemployment rate that's 3.6%. It does seem like labor has a lot of leverage out there right now.
Right. So advantage to labor right in that scenario, given the unemployment landscape. Where is UPS going to find replacement workers if these workers go on strike? That seems like a really tall order. So certainly that concern there, but also looking at other economic factors, supply chain issues, that could certainly hamstring those packages getting to businesses and individuals. But also, if you look at the idea of the shift going, let's say, to FedEx and USPS to pick up the slack here, look, they could definitely take advantage of that opportunity and raise prices for consumers and businesses. So all kinds of dominoes would be expected to fall if this strike does happen. But it looks like the parties are getting back into the negotiating rooms and are looking forward to being able to work something out.
And all of this coming at a time when one of the major trucking lines might also be going out of business come soon. We'll watch the developments in yellow as well. Alexis Keenan, thanks so much for stopping by. All right, coming up on the other side of this, the closing bell on Wall Street, taking a final look at the major averages. About 3 minutes to go in the trading session. Dow trying to hold on to its 10th straight day of gains.
And that's the closing bell on Wall Street. Let's do a check of the markets. The Dow just right around the flat line. We'll see where the final trades shake out, whether or not we'll get that 10 straight days of gains. This is, I don't know, it's too early to call. Miles, you were supposed to bring the good luck here.
Well, 3 points is up.
3 points is up. It looks like we're settled for now. All right, so 10 straight days of gains for the Dow. We'll see whether or not that momentum can continue into next week. S&P just above the flat line as well. The Nasdaq closing to the downside here. This market check sponsored by Tasty Trade. Let's break down some of the biggest moves that we've seen over the last several trading days and taking a look at the Dow's performance over the last 5 days, closing up just about 2%. Like I just said, that 3-point gain that we did see today, enough for the Dow to close in positive territory here, Miles, for 10 straight trading days in a row. We've seen a number of Dow components report results over the last couple of trading days. Amex was out this morning. That disappointed the street, the worst performer in the Dow today, but strong results from JP Morgan earlier this week. Johnson & Johnson, that did give the index a little bit of a lift.
Yeah, and I think, watching the Dow's performance this week is watching, the markets overall start to do the rotation that all the bears thought needed to happen. Otherwise, the market was going to go down, which is, we had this narrow leadership where tech is doing all of the driving, pushing us higher. Nasdaq's up 35% or whatever it was at the peak. And everyone says, when's everybody else going to get into the mix? And you look at today's market on a sector level, and you have XLC Communication Services, that's down 1%. Meanwhile, utilities are up 1.5%, healthcare is up 1%, energy is up 0.9%. So you're starting to see these more cyclical sectors get in the mix. That's a little bit more heavily weighted within the Dow. Certainly, the Nasdaq being a laggard, would be indicative of that. But another interesting day in the sense of the indexes, not really telling the story. Like, I think you have to look at sector level and then certainly at some individual names where you had some action today. Look at the kind of life sciences names like Danaher, Thermo Fisher. They were big winners today. And so watching those dynamics play out has really been interesting here as the market moves into the phase that, again, quote unquote, everyone said we needed to enter if we were going to have a more constructive kind of bull run.
Yeah, and there was certainly a lot of, worry going into this week at exactly what the banks were going to tell us. I mean, when you compare maybe the results from JP Morgan to the results of Goldman Sachs, obviously a very different picture, not exactly surprising, something that we did expect going into this earnings season. But when you take into account some of the other banks that we also heard from, because regionals, and it almost seemed like investor sentiment there was, it's okay. It's better than expected. Deposit levels look like they have stabilized just a bit, and the market, at least right now, looking at that as a win.
Yeah, and I know we have, we could take a look at a couple of different regionals. Western Alliance was one of those names that, all of a sudden everybody knew that stock. I think we have Western, Zions Bancorp, and KeyBank on this chart. And you look, all these names over the last month up at least 15%. Western Alliance up quite a bit more than that. All these names higher on the week by more than, I think it's more than 10%. Can't quite make that out there. But we have seen these names move higher on their earnings. And it is funny looking at both the reaction in these stocks and the way that these management teams talked on the call to think that it was only, 3.5 months ago that we were like, maybe there's another banking crisis. How many more banks will fail? And Western Alliance was certainly one of those names that there was a lot of concern about in the market, the viability of the bank at all. And now you kind of get on the other side of that. You remember folks coming on the show almost every day saying, there might be a big opportunity here. And here's the opportunity, I guess. You really have to hold your nose, but this is now turning into the kind of story that I think when you X'd out the unique issues at SVB and others, you could talk yourself into.
Yeah, no glaring credit issues. It seems like at least that is obviously good news here, or enough, I should say. Obviously, it's good news, but enough here for investors, at least at this point. But they're not out of the woods yet when it comes to the fact that they are being forced to pay more in order to keep those deposits. They're at a massive disadvantage when you compare many of those regional banks to the current position of those larger banks, and the fact that that environment might not change anytime soon.
Looking at that year-to-date chart on those names, I think it is fair to say that the old story with regional banks is basically, well, if rates go up, it's good because these are more deposit-heavy banks. Therefore, they can make more money on the spread, the net interest income, right? And, with there not being competition for deposits, the idea is that, well, you can just turn the higher, rate that you can get on a treasury or whatever, move that right to your bottom line. So I think to some extent, investors maybe sleepwalked into this year with this story specifically. And yes, now there's quite a bit of work to do to right-size that, let's say. But ultimately, you are probably not going to see, it seems at this point, look, famous last words, don't clip this, probably not going to see like 10 more banks fail before the end of this year.
I hope you're right.
Feels like
10,
that, right?
Yeah. That seems like a pretty safe
It feels like there will probably be fewer than 10
turn.
banks in the U.S. fail for the balance of 2023. That's my big prediction.
I'm going to side with you on that one. I think it's fair if we can clip that, and we'll see whether or not that holds true. I'm with you on that one. All right, let's also talk about two big earnings results that we got here just within the last couple of days, Netflix and Tesla. When it comes to these two names, the bar was set pretty high. We've seen a massive run up in these stocks. Tesla beating on both the top and bottom line, pressure on margins, the price cuts that we have been talking about. That clearly was one of the issues for investors. When it comes to Netflix, a miss on revenue, also their guidance coming up a bit light for the third quarter for sales. That was a huge issue. And we saw that reflected not so much in today's trading action, but the big drops that we saw in both Tesla and Netflix yesterday.
And we discussed both these names earlier in the day, and I think conversation got a little sideways there. But one thing that stood out to me with Netflix was that they discussed so openly that their main driver of revenue is converting people who already watch Netflix but just don't pay them any money, which is a fine story, and they are certainly committed to it. And you can see Netflix really starting to turn the gears of, well, we captured the market and now we will make everyone pay more for it. But I think on the margins, with a name that's up 50% this year, with a name that has a lot of hype behind it and is still working off, as we can see in this chart, some excesses that we saw, in that 2021, 2022 period, there's still maybe a sense of, is that it? So that's the whole thing. You're just going to monetize people who don't pay you yet? Like, what, is there no more growth? And maybe Netflix is the first one to admit that everybody got Netflix.
Yeah. They
just don't pay me for it. There's no person who hasn't heard of Netflix.
No, there's no person that hasn't heard of Netflix, but the growth opportunity overseas obviously is a very different story than what we've seen play out within the U.S. But when you talk about...
Show me the ARPU. Not as good.
Well, exactly, and that's what I was going to get to, just in terms of future adoption here when it comes to that ad-based business. I think a lot of that base that they would have captured, at least here in the U.S., obviously their largest market, you would think that most of those people have already converted. So then you got to ask, how many more does that mean that are going to be forced off? Do you share Netflix?
I was going to ask you. I am the payor, and my parents are mooching off of me.
Wow.
I know.
Look
Very
at
big
you.
of me. Oh, do you guys pay?
No. Well, we pay our
pay
own.
for it, right?
We pay our own.
How's the kids programming on
one's
Netflix? We Disney Plus, we YouTube. What are we doing?
We Disney Plus, we YouTube, we do Hulu, and we pay for all of those ourselves, which you could argue is probably not the best financial decision there, but they're all necessary, at least when you have young kids. All right, let's take a look at another mover today. Shares of Digital World Acquisition soaring in today's trading session, up 50% after reaching a resolution in a regulatory investigation. Now, the company aiming to merge with Trump's media platform, Truth Social. They settled fraud charges with the SEC for $18 million. Here with more on what this means for Donald Trump's media presence and also what it means for Trump maybe in 2024. Yahoo Finance's Rick Newman. And Rick, how should we take this?
Well, guys, I'm sitting here shedding tears for millennials paying their own Netflix bills.
Here we go. Of course.
Let me just try to get a hold of myself here to talk about Trump and DWAC. So the SEC has, they've cleared the way for this deal to go through. There were questions about whether the SPAC here, Digital World Acquisition, whether they actually broke the rules for SPACs. They were having discussions with the Trump side before they actually announced this SPAC, and apparently they were. So if this deal goes through, they're going to have to pay an $18 million fine. But it does clear the way for the deal to go through. The irony of this is that Trump is kind of stuck on his own platform, where I think he would rather not be. He on Truth Social, he has fewer than 6 million followers on Truth Social. That's probably everybody who subscribes to Truth Social. Most people don't go there. On Twitter, he had 80 million followers. So really, the only people the way people know what Trump is putting on Truth Social is if somebody then puts it on Twitter, so the rest of the world can see it. And of course, if he's running for president, he wants all the publicity he can get. So he's in a bit of a pickle, but he has committed to his own platform. And some people thought he would jump back over to Twitter when Elon Musk bought it and said Trump can come back, but he hasn't done that. So maybe he'll just stay there.
Rick, speaking of Donald Trump getting into trouble, another busy day for Trump. Federal judge setting a trial date for Trump's handling of classified documents. This story continues to kind of wind its way through the courts. And I guess your thought on where this fits in the context of Trump's run in 2024 and what to make of the Donald Trump experience as we sit here and the July 2023.
I mean, it's amazing and mind-boggling. So if this trial date holds, it would be May 20th of next year. That basically is in the interregnum between when the Republican primary elections will be winding down and then when the Republicans have their convention to nominate their candidate. If the race is close, it's possible that it will not be decided yet by May of next year, and it will come down to I looked up the schedule today. I think there are 10 states that will have the Republican primaries in May and June of next year. So if it's close, it could come down to a few states that are having their primaries right around the time Trump is going on trial here. And just to remind everybody, these are very serious charges, and the case against Trump appears to be pretty strong. This is relating to his misuse of classified documents after he's left office. So, I mean, really unprecedented. And then what if Trump were to win the nomination and get convicted at that trial? Then you would have a circus of a nominating process there where they would be, nominating a convicted felon. He would appeal, but it's possible that Trump will win and be nominated and be a convicted felon at the time. I mean, it's so mind-boggling. It seems silly, but it's unprecedented.
Or be elected president.
Right?
And I mean, and then what? All right.
That could come next.
Well, by my watch, we've got about 16 months to keep talking about this, Rick. Thanks so much for joining us. Yahoo Finance's Rick.
Bye, guys.
All right, coming up here on the other side, Amazon, Google, Meta, Microsoft, and other big tech companies reaching a deal on a set of AI safeguards with the Biden administration. Meta's president of global affairs, Nick Clegg, joins us later this hour to discuss. The FTC and the DOJ have released a draft update regarding merger guidelines. It will be used to guide its review of deals and determine their compliance with federal antitrust laws. Jonathan Canner, Assistant Attorney General of the Department of Justice's Antitrust Division, joined our morning team to discuss the importance of these guidelines.
The importance of these guidelines is so significant that we have set forth a longer than usual process for public comment. So it will be 60 days, and that will expire at the end of September. And we're extremely eager for input from the general public, all stakeholders.
And Jonathan, Rochelle here. I'm looking at the guidelines here, the 13 guidelines. In terms of the ones that are the most significant changes that people should be aware of, especially given the success rate of the FTC in trying to address some of these mergers, what do you think are the key standouts among those?
Yeah, so we built these guidelines. First of all, let me say very clearly that these guidelines are not the law. The law has not changed. The law was written by Congress. It's been interpreted by courts, including the Supreme Court. And we built the guidelines and we designed them to provide transparency regarding our agency practice in a way that reflects the law. So these are the first guidelines ever since they started in 1968 to cite to cases, and we do so extensively. to binding and relevant precedents, including from the Supreme Court, because our merger enforcement, our antitrust enforcement is law enforcement, and we want to be guided by the law.
So I guess, it's Julie here, Jonathan. I guess I'm trying to understand then how you use the guidelines, right? If the law exists, then what do the guidelines do?
Yeah, so the guidelines help provide transparency about how we apply the law. So as the agencies, we have to get filings. When parties want to merge, they submit filings to the Antitrust Division and the Federal Trade Commission. We examine those filings to determine if the merger will substantially lessen competition or tend to create a monopoly. That involves an in-depth process sometimes. More often than not, we don't have anything to say about it at all, and most mergers go through without any investigation at all. But in some instances, if mergers threaten competition, we have the opportunity to investigate. And these guidelines explain how we go about applying our legal framework to the market realities of today and focusing on the realities of how markets actually function here in 2013.
So one of
Sorry,
those,
2023.
It's okay. You went back in time a decade. All right, but one of those mergers that was that was in focus. It was the FTC had sued to block this. The Microsoft Activision deal. It's proceeding. Are these rules, to follow up with what Julie was asking, is this just lip service?
Not at all. So first, let me say these guidelines are forward-looking in nature. They don't relate to any specific case. The case you mentioned is pending over at the Federal Trade Commission, and I defer to my colleagues over there regarding the specifics of that matter. I will say that we've seen a great deal of success in our enforcement program. We've challenged and succeeded in court in blocking the Penguin Random House Simon & Schuster merger, the American Airlines JetBlue merger. And when we look at the total number of trial victories plus abandonments, either post-litigation or prior to litigation, we've seen success in over 15 transactions. That is a record that I'm extremely proud of. And one of the things that we do is we follow the facts in the law, and we make sure that we're applying the law using state-of-the-art economics and analytical tools. And that's what we've done in creating these guidelines, is we've built them around the legal foundation that courts are going to apply when we bring cases before them.
And Jonathan, obviously some of these multinational companies here, and sometimes you'll see the EU rule a certain way and take a certain lead. How much are these guidelines influenced by some of the actions that you've seen perhaps taken by the EU on some of these merger decisions?
Yeah, so again, I think the law has not changed, right? The law was written by Congress. It was very clear that if a merger, it's a risk assessment, may substantially lessen competition or tend to create a monopoly, then we have the ability to intervene. And that's what we're doing. And so the guidelines are really designed to help explain how that law might apply or how we might go about investigating as part of our agency practice to apply that law. Now, there's an important nuance here, which is that, and I'll get it right this time, in 2023, our markets look very different than they did 50 years ago when phones had rotors, or even 15 years ago when most people, not my dad, would stop at a gas station to ask for directions. And so
nobody's dad, Jonathan.
Yeah, I know. I'm a dad now, so I'm familiar with that affliction. But I think market realities have changed, and it's important that we're using state-of-the-art economic analysis to apply the law to how markets actually function. And so when updating these guidelines, we've not only made sure to, in our view, faithfully and accurately reflect the state of the law, but we've also made sure to faithfully and accurately reflect the state of market realities in economics and economic analysis as it exists here today in 2023.
So there's some criticism that this is political when you are unfairly targeting certain sectors like big tech. What do you say to that?
So I encourage anybody with those criticisms to read our guidelines, because what you'll see is they're business model agnostic. They don't focus on any specific companies or any specific businesses. It simply says we want to protect and preserve competition. It focuses on competition. And in order to protect competition under the law, we have to make sure that we recognize market realities. Market realities today include data. It includes platform technologies. Markets are no longer two-dimensional, vertical or just horizontal, but they're multidimensional. And this is not just true for consumer tech or enterprise tech. It's true across our economy, healthcare, energy, industrials, fintech. It's everywhere. And so it's important that those economic realities are recognized and that when we apply the law, we're doing so, again, with understanding of how our markets function today.
All right, and our thanks to Jonathan Cantor, Assistant Attorney General of the Department of Justice's Antitrust Division, as well as the Yahoo Finance Morning Team.
Well, the Women's World Cup began Thursday, and analysts at Wells Fargo, well, they say it could be the most watched women's sporting event of all time. Yahoo Finance's Josh Schaefer has the story for us. You've been digging into this report from Wells Fargo, but just in terms of the views that we're expected to see during this year's World Cup, how does that compare?
Yeah, people are very excited for the World Cup this year. As you said, might be the most viewed Women's World Cup we've had yet. You remember back in 2019, this USA women's team really kind of had a big seminal moment over the summer because it's in a nice spot in the sports calendar, right? When we think about what there is to watch right now, the British Open's going on right now, but other than that, there's really not a whole lot. We're kind of waiting for NFL season to kick off. There's going to be a lot of preseason talk, but generally speaking, it's a nice hole in the sports calendar, and I think that's interesting when you think about a lot of the sports gambling companies that we talk about all the time. When you think about a DraftKings, Caesars, MGM, et cetera, they need sports to be going on to keep having customers come back, right? And this is normally a pretty weak quarter for them, or a weak part of the quarter before football picks up. So I think it'll be interesting to see if they're able to get some tailwinds there, get more people betting. I will say the odds are a little interesting, though. It's not necessarily the most appealing odds.
Josh, please tell us about your picks.
Yeah. So we've got...
You got to be betting on the U.S.
Right, but that's the thing.
Everyone wants to know what you're doing.
I am personally betting on USA. But I think USA won the last two World Cups. They're heavily, heavily favored. So you're looking at plus 250 there. If you were to bet $100 on that, you win $250, which is a nice payday, but you're betting against the entire field. So it's a pretty big bet. Then you see Spain there at plus 400, France at plus 1,000. In other words, Americans normally love the Women's World Cup because we're really good at it versus the Men's World Cup. So I think people normally get very excited for that. Tonight's game, USA women play tonight. They're favored by 6 goals. So you basically can't bet on that.
Technically, I guess they play tomorrow morning.
Right.
Time difference.
Right.
New Zealand. I feel like it's a good time difference, to be honest. I think you can make it work if you're a U.S. sports network.
Bars are opening very early for the games.
Well, that's a Hoboken-specific thing. All right, speaking of soccer, Leo Messi making his debut tonight for, is Inter Miami? Miami FC?
Yeah,
Inter Miami. Okay.
Inter Miami.
I always think it's Inter Milan. I mean, it is Inter Milan, but, you know,
I think
they
might want you to think
Did they
it's
do
Inter
that
Milan.
intentionally? Yeah.
Yeah, I think that's part of the brand strategy.
Other than him shopping at Kroger, Josh, I have not kept super close tabs on this story.
I think the overall story for us here that's interesting is Apple TV, live streaming. How does it go as more and more eyes get there when you're thinking about Messi and how many eyes he does draw? So we know Apple has been doing live baseball now for over a year on Friday nights. It got mixed reviews in the beginning. Seems like people are starting to like it a little bit more now. But I think Messi brings a different audience, new consumer here. Do they get some Apple TV Plus subscribers? Obviously, in the overall story of Apple, I don't think it's a big part of the investor story. But we know Apple has been interested in live sports. You now have the biggest player in the world playing on your platform. How does it go? Do you get more subs? They're paying about $250 million a year for that MLS deal, and obviously they're looking to get a little bit something out of it. So Messi being involved should hopefully help.
Yeah, well, it helped a heck of a lot for the ticket sales for tonight's game. What were they going for?
There was one ticket I saw out there. Someone paid $3,500 to watch an exhibition MLS game, which I can guarantee has never happened before. He's not starting. He might not even play until the second half, according to some reports. So it's an interesting thing to pay $3,000 for when he's going to play all season long.
And the whole schedule sold out, like all their games, right?
Yeah, but he's going to keep playing. Like, why pay $3,000 now when you can see him next month?
All right, hard pivot. You may have seen the viral trend of women eating snacks and calling it girl dinner. Now, of course, the brands have arrived on the scene. Popeyes hopping on the bandwagon. Yahoo Finance's Brooke DePalma joins us now with all the details on this glorious summer Friday afternoon. All right, Brooke, let's start. We'll start with the brands getting involved here.
Right, so Popeyes certainly jumping on this viral trend. They're introducing their version of a girl dinner. Essentially, it's a few sides that make a full meal. So the Popeyes girl dinner will include mashed potatoes with Cajun gravy, home-style mac and cheese, coleslaw, Cajun fries, and biscuits. Now this girl dinner trend kicked off in May after one TikTok user named Olivia Marr said that her ideal meal is cheese with bread along with maybe some pickles and a glass of wine, essentially random sides that are filling and quick. And as you can see here, other users jumping on the trend, saying that they didn't realize that others did the same. They're making it their own. Hashtag Girl Dinner now has 240.8 million views on TikTok, and you're all laughing, but this is a phenomenon right now.
I literally
This is a
feel
big
like
deal.
I am looking at my dinner.
Yes.
For the past
Essentially, when you live by
months.
yourself and you're pulling together a few things.
I don't live by myself, and they still.
Focus on that Popeyes meal. That's a full meal.
If
there's any part of this that's supposed to be, it's not a full meal. That was a lot of food on that Popeyes
But
meal.
you're thinking sides. You're thinking the bread. You're thinking the cheese. You're thinking some pickles on the side. You're thinking olives on the side. Some hummus, carrots. A lot of sides that make a meal rather, and that is a girl dinner.
Sure. No, listen, I just think as you were talking, Brooke, it occurred to me that really what we're discussing here is now on TikTok. Well, no. People do literally just normal things, but now it's just branded as, it's actually this thing. It's like you're just eating.
You just got to be creative with the hashtag.
Yes.
Right. I'm just saying, like, this is just something people do in the world, but now it has a brand. So now it becomes like a viral trend. Well, we had a great conversation. I'm so glad you asked. I'm so glad you asked, Shauna. If a girl dinner is just all the sides, a guy dinner is just only the main event and nothing else.
Just me.
That's a heck of a lot of work, though. You guys are missing out.
Same amount of work.
But I do have to say also, Popeye's really looking to bank on this. McDonald's tapped into social media trends back in 2022. They used 4 menu hacks. They added it as a marketing promotion. It ends up boosting sales that quarter. And so we'll wait and see to see how well this girl dinner does.
This is like the AI buzzword for all the food companies as they report earnings next week. All right, Brooke De Palma, Josh Schaefer, thanks for stopping by.
All right, let's do a check of the markets. This is sponsored by Tasty Trade. Again, the Dow closing in the green for the 10th trading day in a row. It's the longest streak that we have seen in years. S&P closing just above the flat line. The Nasdaq in the red, off just about 0.2% for the day. Well, the Biden administration announcing it has reached a deal with 7 tech giants to safeguard artificial intelligence. The White House saying that the move will ensure that AI products are safe before introducing them to the public. And the companies say that they will earn the public's trust. Our next guest just wrapped up a meeting with President Biden. Joining me now, Meta President of Global Affairs, Nick Clegg, along with our own Ali Garfinkel. Nick, it's great to have you here, and I know you're very busy. What can you tell us about the discussions with President Biden, what exactly was discussed within the meeting, and how you plan to enforce some of the guidelines that you laid out?
So the conversation with President Biden and his team was really around the following. AI is developed. It's not new. AI has been around for years, but it's now evolving very fast with these so-called new large language models like ChatGPT, where you can ask it, to write your school history essay or your wedding speech, and it comes out with perfect text. It's moving very fast, and with every kind of fast-moving technology, which is the technology is bigger than any single company or indeed any single country, there's always legitimate questions about how to strike the right balance between moving fast with these innovations but doing so responsibly. And I think all of the companies, including Meta, we kind of agree with that. We want to strike the right balance about moving forward. These US companies have a real role of world leadership in this technology, but to do so in a way that people feel is transparent, so people can see for themselves how these systems work, to make sure that they're properly stress tested, so you have so-called red teaming, to make sure that wherever possible, it's not always going to be possible, you can detect and inform people where content has been generated by AI systems rather than by human beings, to publish research, to work collaboratively across the sector and so on. And that was the topic of the conversation. That's the subject of those voluntary commitments that all the companies have made. And I think certainly I can speak for Meta, we are absolutely determined to follow up and honour these commitments, because it's beyond everything else, it's in our own interest to do so. We want to make sure that any technology that is deployed, that we come up with, is deployed as responsibly and safely as possible.
Nick, there has certainly been many dramatic predictions when it comes to AI, right? You talk about how it's all about striking that balance, but there's been predictions everywhere from massive job loss to misinformation, disinformation, and then all the way to some saying that it could actually trigger the end of the world. I'm curious to get your take outside of those dramatic predictions. What is your number one risk or the number one threat that you're worried about when it comes to AI?
So I think quite a lot of the sort of existential, it's going to end humanity and turn us all into paper clips by next Tuesday predictions, I think they've kind of slightly run ahead of the technology. The technology is absolutely not in any position to do any of that. In the end of the day, you've got to remember these large language models, they're like some giant autofill. They kind of just guess the next word, or actually they turn the words into tokens in a sentence in response to a human prompt. So I think those concerns can be set aside. I think some of the concerns around deep fakes, the manipulation of audio and video and images and so on, I think that's a legitimate area of concern. But I would say that the technology which generates that unwelcome material is also the technology we will use to actually sort of identify and control it. So looking at our own experience in Meta, for instance, AI has been a fantastic weapon in our own defenses against misinformation, disinformation, hate speech, and so on. I'll give you a very concrete example. Hate speech on Facebook, the prevalence of it is now down to 0.02%. So that means that for every 10,000 bits of content you might see, if you're scrolling endlessly on Facebook, you might see 2 bits of hate speech. And that is down by over 50% over the last couple of years, purely because of advances in AI. So it's an adversarial space. In exactly the same way that AI can create problems, it can also solve those same problems. And that's exactly the kind of thing that companies like Meta should, and we must continue to invest in.
Nick, Ali here. What is Meta's stance on regulating AI?
Oh, I definitely think you need regulation. I think with new technology like this, of course, it needs to be framed by democratically agreed laws. There are so many, complex issues around use of data, copyright, intellectual property. How do you make sure these systems are safe and transparent? How do you make sure they're properly stress tested? What kind of regulatory bodies you need to invent if you don't have sufficient ones already? And all of that needs to be, of course, decided upon by legislators in this town in DC. That's why we're working at Meta, and all the companies are working closely with Senator Schumer and others as he's leading an effort to across parties to see what political agreement there might be around this. But it doesn't, we're not going to sit around and wait for legislation. That's partly the point of these voluntary commitments. I think they will end up sort of providing the guts of a lot of legislation, both here and in other parts of the world. But why it was so useful that the White House kind of pushed all the companies to be involved in all of this is it means that we were starting to be able to agree on some basic swim lanes on what is and what is not desirable well before legislation is actually passed.
To that end, Nick, Meta has made its large language model open source. Won't that in theory make it more difficult to regulate, more difficult to manage?
No, I mean the history of open sourcing, the whole internet has been built on open sourced technologies, and we've been open sourcing AI tools for years. For over the last decade, I think we've open sourced over 1,000 AI databases and models. The basic spirit of it is that if you put these technologies, because they're very expensive to build, there are only a few companies that have got the very expensive computing capacity to build them. If you make them available to academics, researchers, developers, entrepreneurs, that in turn creates a kind of flywheel of innovation, which would not be possible if it was only if these systems were kept under lock and key by the companies themselves. And I should stress, of course, we wouldn't release a model like this if we felt that it posed some existential threat to the world. So I explained earlier, these large language models, we will look back on them in several years to come. The large language models of today are still relatively primitive. They are, as the name implies, they're large language models. They're literally just guessing the next word in a string of words. But we think right now, given the relative immaturity of these large language models, and given all the stress testing we've done, we had 350 people so-called red teaming these models for several months before we release them to others, means that we can strike that balance of yes, innovating, but also making that innovation available to more people, which in turn hopefully leads to far more innovation in the AI economy as a whole.
Nick, when it comes to misinformation on AI, there's been lots of talk about how this could potentially influence or what the run-up to the election could look like now that we have AI and the mass adoption of AI When it comes to Meta's role in this and how you're approaching the 2024 election, because now you also have Threads, which has over 100 million users, what does your playbook look like this time around?
I think the key thing I'd like to say about this is that the way we build our systems, not least our AI systems, which make sure that bad content, nefarious content, whether it's disinformation, whether it's foreign attempts to interfere in elections, whether it's hate speech and so on, that those systems will tackle content regardless of where it's created, whether it's created by a human being or by a machine. So whilst the volume may change, the fundamental architecture of our protections, which we've built up over the years, and not least because of the experience of what happened back in 2016, and because of the immense advances in AI. We've spent $16 billion over the last few years on those kind of defenses and protections. We have tens of thousands of people working on this around the clock. Those AI systems will tackle misinformation, disinformation, where we can identify it, regardless of its source. And that's, I think, important to remember. It's not as if, as I say, the velocity and volume may change, but the fundamental power we have is because we are a platform that can control the distribution of that content. Is as long as we can identify it, we can then restrict or even remove that content if we find it.
Nick, this all totally makes sense to me, but my question is, how do we know it's going to work? Let's fast forward 18 months, let's say. The election is over. How do we know that Meta has succeeded in mitigating misinformation?
Well, look, my crystal ball is no clearer than yours. All I can point to you, so I can't tell you exactly what's going to happen in the future, and particularly not in something as unpredictable as elections. What I can reassure you about is that, do remember we're a global platform. Over 95% of our users are outside the United States, and we have elections every single month in many different parts of the world. So it's not as if we only ever have to prepare ourselves for the US election. We have teams, we have highly sophisticated automated models, which are working to deal with elections non-stop, all year round, month in, month out. And with each election, we learn more because it's a very adversarial space. So I do think we're getting better. We have constant practice in doing this. We have made massive investments, I think, world-beating and certainly industry-leading technology to deal with misinformation, disinformation, and so on. We give users as much information as we possibly can. And as I said earlier, it doesn't really matter from our point of view whether the material, if it's unwelcome and we want to block it or restrict it, is produced by a machine or a human being. We will try and tackle it. But look, so I can only sort of tell you that I think we try our level best, and we do so on an ongoing basis. But exactly how that'll play out, well, that's something that obviously we can speak about after the elections themselves.
All right, Nick. Well, thanks so much for taking the time. We have to leave it there. We hope you come back and visit us again soon on Yahoo Finance. Nick Clegg of Meta President of Global Affairs, and of course our thanks to Ali Garfinkel as well.
All right, it's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. ESPN reportedly holding talks with top sports leagues to find strategic partners. That's according to CNBC, which says the network has held preliminary talks with the NBA, NFL, and MLB about bringing them on as minority investors. The report also saying a variety of new partnerships and investment structures are being considered. This news coming roughly a week after Disney CEO Bob Iger said in an interview that he is looking for a strategic partner for his ESPN channel. Spotify reportedly planning to increase the price of its premium plan in the United States. The Wall Street Journal saying the price will go up by $1 to $10.99 a month and will be officially announced next week. This coming just one day after YouTube announced it's raising the price of an individual music streaming plan to $10.99 a month. And Amazon reportedly making a push to get its employees back into the office. That's according to the Wall Street Journal, which says the tech giant is asking some employees to relocate to offices in main hub locations, including Seattle, San Francisco, and New York City. The Journal doesn't make clear how many employees or teams will be affected by the move.
Time now for what to watch next week. Another busy earnings week is in store for investors. Tech giants Microsoft and Alphabet are going to kick things off for us, reporting second quarter results on Tuesday. Meta will follow later in the week. Investors are going to be eager to see how these results shake out after big tech stocks have driven much of the market's gains since the start of the year. Traders are also going to be looking forward to a slew of fast food earnings next week. That's going to provide a closer read on the consumer and also on spending behaviors. McDonald's, Chipotle, Domino's among the names to keep a close eye on. And also in focus, Federal Reserve Jerome Powell will be taking center stage once again to report the latest on the Fed policy decision, largely expecting another rate hike at the meeting next week. Most economists there expecting a 25 basis point hike in July, while the Fed's last month pointed to 2 more potential hikes this year. We'll have to see what the Fed makes of the latest economic data in its fight to cool inflation. All right, well, that does it for us today on Yahoo Finance Live. Thanks so much for hanging out with me, bud.
That was great. Wow, Sweetgreen on the fast food bar now.
I know.
That's big for Sweetgreen.
It is big
I'm not
for
sure that's in the
Sweetgreen.
S1 for them.
I didn't even notice I was up there. Well, we didn't even mention it. We got to see. You're going to have to come back and talk to us about earnings next week.
I'll be back Thursday to talk about it.
Well, there we go. You heard it
not
here
true.
first. All
That's
right,
not
guys,
true.
that does for us today and for the week on Yahoo Finance. We'll see you right back here again on Monday. Have a great weekend.